Welcome back to Talk Tickers, a show for the institutional grade investor where we strip away the noise and get straight to the signal. It is Tuesday, January 20th, 2026. I hope your screens are green, but if you're heavy in banks today, you might be staring at a lot of gray.
Yeah, flatline is probably the right word for the sector today.
Exactly. So today we are locking in on US Bancorp, ticker symbol USB. This was a pre-market print that had the street buzzing, or at least the setup suggested it should have. We were all looking for this quality compounder story in the middle of a very noisy regulatory environment. But the market's reaction was, well, muted.
Muted is polite. It was a collective shrug. I mean, you have the entire banking sector sort of holding its breath, waiting on this policy overhang with credit card rate caps. But then you have US Bancorp trying to very deliberately pivot that whole narrative.
They don't want to talk about regulation.
No, they want to talk about fee diversification, about their capital markets execution. And honestly, looking at these sheets, they have a pretty strong case.
They really do. So the mission for today's deep dive is clear. We are going to dissect a record revenue quarter that the market met with. Frankly, total indifference. We need to figure out if that shrug is an opportunity or if it's a warning sign. So let's start with the headline numbers. US Bancorp delivered GAAP EPS of $1.26.
Which is a beat.
A solid beat. The consensus was sitting at $1.19, so they came in about 7 cents ahead.
And just to put a bow on that, the top line, they posted record net revenue of $7.365 billion. That's up 5.1% year over year. I mean, in this environment, 5% revenue growth is significant.
It is. And we saw the algos react to that right away.
Yeah.
The stock popped, about 1.7% intraday?
Yeah.
But then the fade just set in. By the close, shares were basically flat down, maybe 4 basis points at close at $54.38.
Right.
Volume was high, around 13.5 million shares, so we're trading it. They just weren't chasing it. So why the disconnect? Was there something dirty in the numbers?
That's the first thing I looked for. Because usually you see a beat and a flat close. It means it's low quality, right? A one-time tax benefit, or they just released some reserves to make the quarter look good.
Little accounting magic.
But this was a clean beat. I went through the transcript, the supplementals, no tricks. This wasn't just cutting costs to prosper. It was legitimate top-line growth driven by net interest income and, broad-based fees.
So if the quality was there, what is the market so scared of?
I think the sentiment is that the market's just pricing in the regulatory noise. The talk around the Credit Card Competition Act and those rate caps, it's being treated as good, not game-changing print. The market is basically saying, great quarter, but we are terrified of what Congress might do to your credit card business next year.
Right. Okay, we'll get to the scary congressional stuff later because that's a whole beast. I want to get under the hood of the bank first. Management used a specific phrase that I want you to unpack for us. Remixing. They said they're remixing the balance sheet. Now, that sounds like marketing speak. What does it actually mean?
It's a fancy way of saying they're swapping expensive ingredients for cheap ones. In banking, your raw material is cash. And for the last couple of years, banks have been relying really heavily on CDs, certificates of deposit, to fund their loans. CDs are expensive. You have to pay a client 4% or 5% to lock that money up.
Right, because you're paying out more interest to your depositors. That eats into your margin.
Exactly. But this quarter, US Bancorp cut their CD usage by $6 billion. That's the lowest their CD balances have been in 10 quarters. They just let those expensive liabilities roll off and replace them with consumer deposits, checking accounts, savings accounts, which cost them way, way less.
I saw the CEO, Gunjan Kedia, highlight record consumer deposits. So they're bringing in cheap cash to replace the expensive cash.
Which is the holy grail for a regional bank right now.
Right.
If you can lower your cost of funds while rates are easing, your net interest margin, that spread, it expands. Their NIM hit 2.77%, up 6 basis points year over year.
Now, that doesn't sound like much, but on a balance sheet that size.
It's massive. Absolutely massive.
Okay, so the funding side is getting cheaper. Makes sense. But what about lending? Who are they lending to? Because I saw commercial real estate CRE actually showed growth. And usually when I see growth in CRE in the same sentence in 2026, I start getting nervous about empty office towers. Is that a red flag here?
It's a natural reflex to think office apocalypse when you hear CRE, but you have to look at the subsectors. Their office exposure is actually down $3 billion over the last 3 years.
Okay, so they're not lending on empty skyscrapers.
No, the growth they're seeing is in multifamily housing and industrial logistics centers.
So apartments and Amazon warehouses.
Exactly. It's the stuff people actually use. So yes, the loan book is growing, commercial loans up 10%, credit cards up over 5%, but it's targeted smart growth.
So growing the loan book in the right places, funding it with cheaper cash, that explains the NII strength. But the other pillar here is the fee diversification. They want to be less reliant on interest rates entirely. Total fees came in at over $3 billion, up almost 8%.
That's a very healthy number. You saw strength in payments, trust, impact finance. But there's one specific niche here that I think the market is just completely sleeping on. Global Fund Services, or GFS.
Right, I saw that slide. It sounds incredibly boring.
It is boring, and that's why it's beautiful. Revenue there grew 12% in 2025. But here's the stat that floored me. US Bancorp onboarded nearly half of all new US ETF launches last year.
Wait, half? As in 50% of the entire market.
Yes. Think about the ETF boom we're in. Active ETFs, crypto ETFs, all those covered call strategies. Everyone is launching a fund. US Bancorp isn't picking the stocks. They're providing the plumbing, the custody, the administration. They're handling the paperwork. It's a sticky, recurring fee business that just grows as the markets grow.
That connects to what Katie was saying about interconnected product solutions. It's not just lending money, it's servicing the fund that the client is launching.
Precisely. And that creates a nice buffer. If rates crash and lending makes less money, that fee business just keeps chugging along.
Okay, let's tie this all together with a metric management kept pounding the table on. Operating leverage. They posted adjusted positive operating leverage of 440 basis points in Q4. For the listener who doesn't live inside a bank spreadsheet, why is that number so important?
Operating leverage is the ultimate measure of productivity. Simply put, did your revenue grow faster than your expenses? In this case, yes, revenue was up nicely, but expenses were basically flat up, less than 1% from last quarter. That 440 basis points is the gap between the two.
So they're making more money without spending more money.
That is the definition of execution. It proves the productivity thesis they've been selling. They're not just getting lucky with interest rates. They're actually running the machine more efficiently.
Which brings us to the moment where they did decide to spend some money. We have to talk about the elephant in the room, the BTI acquisition.
Yes, the BTI deal. This is the big strategic pivot point.
So the specs, up to $1 billion price tag, expected to close in Q2. The whole idea is to fill that capital markets GAAP equity execution M&A advisory. The logic seems pretty simple. We lend these companies money, so why are we letting them go to Goldman when they need to do an IPO?
That is exactly the logic. It's about capturing fees from clients who are already in the building. Katie noted they've partnered with BTIG for 10 years on over 350 deals. They know these guys. It's all about that link and leverage strategy, selling more to their existing 15 million clients.
But isn't there a risk here? I saw a competitor call this style drift. They argued a conservative regional bank has no business getting into volatile equity trading. It feels a little, I don't know, Wolf of Wall Street for a bank in Minneapolis.
And that's a valid criticism. Usually I'd agree, trading desks can be dangerous. But the CFO, John Stern, had a specific rebuttal. He clarified that BTIG is balance sheet light, meaning they aren't a prop trading desk. They're not gambling with the bank's capital. It's an agency model. They execute trades for clients and take a commission. It's a fee play, not a risk-weighted asset play. They're just facilitating the trade.
So it moves them towards being a real Wall Street alternative for the mid-market, but without betting the farm.
Exactly. It diversifies the revenue without wrecking the risk profile.
Speaking of alternatives, let's hit the innovation corner. Digital assets. They completed a cross-border stablecoin pilot. Now, usually when I hear legacy bank and crypto pilot, I just assume it's a PR stunt. Is there anything real here?
Management was surprisingly honest. They admitted the revenue isn't there yet. This isn't driving EPS in 2026. But they are positioning for compliant commercial offerings.
Compliant being the key word.
Always. US Bancorp is not about to launch a meme coin, but think of it as a defensive move. They already custody $12 trillion in assets. If stablecoins become the main way corporations move money because it's faster and cheaper, US Bancorp doesn't want to get disintermediated by some fintech. They're building the plumbing now so they can own the rails later.
It's a call option on the future of payments. I like that. Let's zoom out to the investor context. They gave us the 2026 guidance. What's the roadmap look like?
The forward look is solid, revenue growth of +4% to +6%, and that excludes BTI. If the deal closes, that number goes up. They're targeting at least 200 basis points of positive operating leverage. And for Q1 specifically, they're guiding NII up 3-4% and fee revenue up 5-6%.
And for the shareholders who like cash in their pocket, buybacks are back on the menu.
They are, moving from $100 million to $200 million per quarter, with a goal of getting to a 75% payout ratio. That's a very shareholder-friendly signal.
Okay, let's talk about the vibes, the macro backdrop. The CEO mentioned the one big beautiful bill. I assume she means the upcoming tax provisions.
Yes, specifically around tips and overtime being tax-exempt. She cited it as a potential consumer tailwind.
Interesting. If service workers keep more of their paycheck, they deposit more, spend more, maybe pay down their credit cards.
It was a very specific call-out. But on the other side of policy, you have those regulatory clouds, the credit card rate cap, the proposal for a hard 10% cap.
Which sounds just disastrous for a bank.
Kiria called a 10% cap crushing for the economy, but she noted the conversation is shifting away from blunt caps toward consumer options. She mentioned their Shield card with 0% APR for 24 months. The key takeaway is that US Bancorp is not planning for that cap as their base case. They think it's unlikely.
And on credit quality, it seems the soft landing has actually landed.
It appears so. Net charge-offs dropped to 0.54%. Delinquencies are stable. For their borrower base, the crisis seems to have been averted.
So we've got solid execution, regulatory fears priced in, and a strategic pivot. That brings us to my favorite part of the show. We're going to transition to the prop desk segment.
Let's do it.
This is where we pitch a trade idea. It's wild, it's plausible, but I have to say it loud and clear. This is not financial advice. Do not try this at home. But if you were sitting at a hedge fund, this is the pitch you might hear.
I'm calling this one the Boring Banker's Crypto Hedge.
I love the title already. Break it down for me.
Okay, here's the setup. US Bancorp is buying BTI for institutional trading, and they're quietly building stablecoin rails. All while the stock is trading at a boring bank multiple, even though it has a return on tangible common equity of 18.4%.
Right. It's valued like a utility, but it's building a trading desk.
Precisely. So here's the trade. You go long US Bancorp, USB, and you go short high beta crypto exchanges or pure play fintechs.
Oh, that is spicy. So you're betting on the bank and against the disruptors. Why?
Because of the regulation we just talked about. As Basel III and new stablecoin legislation tighten the screws, the Wild West crypto volume is going to be forced into regulated channels. It has to move to boring, compliant custodians like US Bancorp.
So the volume leaves the unregulated exchanges and goes to the bank that already knows how to follow the rules.
Exactly. By going long USB, you get that 4% yield from dividends and buybacks. That's your safety net. By shorting the pure plays, you're hedging against that regulatory crackdown. You profit if the regulators strangle the fintechs because that volume has to go somewhere, and USB is building the plumbing to catch it.
And there's a kicker on the valuation, right?
The kicker is multiple expansion. If that BTIG deal closes and they prove they can cross-sell to their clients, USB's fee multiple expands.
Okay.
They stop trading like a regional bank that's sensitive to interest rates, and they start trading more like a diversified financial firm. It detaches them from that whole basket.
I'm reading that trade. The tortoise eats the hare.
It's aggressive, yet oddly conservative. You're basically shorting chaos and longing compliance.
In a heavy regulatory environment, compliance is a growth strategy.
Fascinating stuff. All right, let's wrap this up. Give us the recap for the people in the back.
Record revenues, $7.365 billion. Clean EPS beat at 1.26 cents. And an efficiency ratio down to 57.4%. So the verdict seems to be that USB is executing that quality compounder playbook perfectly. The market was just a bit too distracted by macro noise to reward the stock today, which, that might be the opportunity.
I agree. My final thought is that the BTIG acquisition is the pivot point. We have to watch the integration. If they do it well, they stop being just a lender. They start being a true Wall Street alternative. But integration is hard. That's the risk to watch.
And for a call to action, watch the Q1 NII growth. Management promised that the deposit remixing is working. We need to see that hold up in the next print.
Absolutely. If those deposit costs start creeping back up, the whole thesis weakens.
Well, that is all the time we have for today's deep dive. Remember, everything we discussed is for entertainment and information purposes only. We are not financial advisors, and you should always do your own diligence.
Markets change fast. Stay informed.
Thanks for listening to Talk Tickers. We'll catch you on the next print.